Bill Hwang, the founder of Archegos Capital Management, was found guilty of fraud and market manipulation in a historic case that has rocked the financial industry. The high-profile investigation into one of the most spectacular disasters in recent Wall Street history comes to a close with the verdict. So let's begin today's video. Overview. You may remember from the spring of 2021 the strange name Archegos, a little investment firm that collapsed almost overnight, leaving major Wall Street banks worried about losses running into the billions of dollars. On the other hand, it also makes sense that you might have been overly busy with planning your COVID-19 vaccination, as well as emerging from lockdown for the first time in a year. In summary, Archegos Capital Management made enormous bets that, in a manner similar to the disastrous collapse, wiped out almost $100 billion in market value in a matter of days. However, just over 2 years after the firm's demise, its 60-year-old founder and CEO, Bill Hwang, will stand trial on 11 counts. What happened? According to the indictment, Archegos created a series of fraudulent schemes to artificially raise the value of a number of publicly traded stocks, including Discovery and Viacom. In other words, the prosecution claims that Hwang had gained exposure to the stocks without really owning them by using financial instruments known as total return swaps. Even though it is legal, doing so is very risky and contentious. The issue is that Hwang and his group are suspected of lying to the banks they borrowed money from, using swaps to hide the large stakes they were accumulating in order to get around legal restrictions. For a while, that worked. Prosecutors claim that in less than a year, Hwang increased the value of his $1.5 billion portfolio to $35 billion. But Hwang got himself into difficulty when the value of those stocks abruptly dropped. Hwang first tried to buy up more shares to stop the share price decline, as banks wanted more collateral to pay the losses. It didn't work, and bank margin calls kept flooding in, eventually forcing banks to liquidate the firm's positions, further reducing stock prices and leaving Archegos owing billions of dollars to banks that were left holding the bag. One of those institutions was Credit Suisse, which suffered a $5.5 billion loss on its loans to Archegos, contributing to the lender's downfall a year later. According to the indictment, Archegos' collapse wiped out more than $100 billion in apparent market value for nearly a dozen companies. Notably, the media behemoth Viacom lost over half of its value due to the fire sale. A bit about Bill. A complaint brought by a former employee claims that Bill Hwang, the son of a Korean pastor, is a passionate Christian who doesn't hesitate to share his beliefs with everyone, even his employees. In the lawsuit, a former employee accused Hwang of leading a toxic culture that promoted employee submission and adulation. Hwang allegedly encouraged his employees to devote more time to their beliefs and attend scripture readings. Employees were supposedly compelled to contribute at least 25% of their incentives to the company's deferred compensation plan, which lost $500 million when Archegos failed. Even the term Archegos derives from the Greek word for leader and was used in the Bible to refer to Jesus Christ. A recent Bloomberg article described a massive piece of art Hwang commissioned, in which the blood of Christ washes over a grey New York City skyline, cleansing the great metropolis of its sins. This is not his first run-in with the law, his criminal trial. He entered a guilty plea to wire fraud in 2012 in connection with his Tiger Asia Management hedge fund, which was involved in an insider trading controversy. Why the case matters. Most Americans would think white-collar crime on Wall Street is a far-off issue, and maybe they are right. However, if you have a retirement fund, you should be concerned about market shenanigans. And sometimes, as in the financial crisis of 2008, it was a bit of Wall Street tinkering in derivatives contracts that blew up in banks' faces and collapsed the housing market. The DOJ appears to be using a more aggressive approach to fraud than it has in the past, as evidenced by the Archegos charges, which hold Hwang and 2 of his accomplices legally responsible. The Archegos debacle did not occur in a vacuum, stated Dennis Kelleher, CEO of Better Markets, a non-profit advocacy organization. It was enabled by lax regulatory policies that have allowed excessive risk into our financial markets. Hwang has pleaded not guilty to 11 federal charges, with each carrying a maximum sentence of 20 years in prison. The legal proceedings. The jury started deliberations Tuesday afternoon and quickly found Hwang guilty on 10 of the 11 criminal counts. Patrick Halligan, Hwang's deputy and co-defendant, was also found guilty. The criminal verdict came after prosecutors claimed Hwang's family business, Archegos, lied to banks to conceal significant stock acquisitions, and artificially inflate stock values. Hwang's firm's stakes like Viacom CBS, Tencent and Discovery were so big that when the stocks fell, it sent shockwaves through the market. Prosecutors said that the collapse of Archegos cost banks $10 billion and stockholders $100 billion. However, Hwang's attorneys asserted that Archegos' aggressive trades were legal. The Southern District of New York U.S. Attorney's Office stated in a statement that Hwang's guilty conviction sends a message that market manipulation would not go unpunished. Hwang and Halligan were able to fraudulently inflate a $1.5 billion portfolio into a $36 billion portfolio, the statement said. This verdict should send a resounding message that this office will continue to police the financial markets with an eagle eye and swiftly hold accountable those who think they can cheat the system. Hwang, who is 60 years old, faces up to 20 years in prison on each charge. Finally, Bill Hwang's conviction highlights the need for increased accountability and transparency in financial markets. While his activities produced short-term profits for his company, they ultimately resulted in widespread losses, highlighting the weaknesses within the system. As regulators work to address these issues, investors can only hope that lessons learned from this debacle will lead to a more stable and resilient market environment. Thanks for tuning in to another eye-opening episode on Capital Crimes, where we uncover the truth behind the dollars and cents. Before you go, fam, remember this: knowledge is power and action is key. If you're as passionate about uncovering financial wrongdoing as we are, then don't forget to drop a comment below with your thoughts, smash that subscribe button and share this video with your squad. Together, let's keep exposing the dark side of the financial world and keep chasing the truth.